Hey everyone, I'm Jeremy Szafron. This is Kitco News. Don't forget to hit that subscribe button for the latest. As we kick off September, a historically turbulent month for the markets, we've already seen some significant moves. The S&P 500 and the NASDAQ are showing signs of strain, and investors are bracing for crucial economic data, including the latest jobs report expected this week, which could heavily influence the Federal Reserve's next move on interest rates. But it's just not the equities grabbing attention. Gold is holding steady near that $2,500 an ounce mark on the spot side, despite the volatility in the markets. And according to the World Gold Council's latest report, central banks continue their buying spree, doubling their purchases in July. And Goldman Sachs this morning with a new report projecting gold could hit $2,700 by early 2025, citing strong demand and expected rate cuts as key drivers. Now, let's take a look at the technicals. We welcome back our technical analyst, Gary Wagner, this week from Chart This, of course, from goldforecast.com. Gary, good to see you.
Great to see you. Great to be here. I hope everyone's had a good 3-day weekend.
Amen to that. I think everyone's feeling like it just needed to be a little longer, but maybe I'm just speaking for myself. Okay, let's jump into it. Obviously, I mentioned we're in a little bit of a funny time as we wait for economic data this week, and of course, moves from the Fed on interest rates. But with equity markets moving downward today, gold seems to be really holding up here. Talk to me a little bit about what you're seeing in gold, Gary.
Yeah, absolutely. The interesting thing that we are seeing in gold is the fact that although gold traded under pressure this morning, and I'm referring to December futures above 2,500, it seems as though every time it's gotten close to that kind of key psychological level, I think the low today was 2,506, traders come in and buy the dip. They look at that as an opportunity rather than fading the market and taking it lower. And that to me shows that gold has been resilient. And it's resilient for a couple of reasons. The primary reason is the floodgates have opened up, so to speak, with Powell's comments at Jackson Hole just a few weeks ago, in which he said that it's time for a policy change. So he is signaling that they're going to cut rates, although he hasn't really talked about a timeline. The inferences by almost across the board in terms of analysts is that September will have a rate cut. And the question is, how deep will that rate cut be? And that's where the jobs report and specifically the unemployment numbers are going to come in. Because if the Fed sees some weakness in the labor market, that would give them the incentive to do what we call a jumbo rate cut, a rate cut of 0.5%. And the odds of that, according to the CME's FedWatch tool, are 36% that there will be a rate cut of 0.5%. And that would really move gold. That would be a catalyst that would drive gold to higher pricing.
Yeah, it's wild. Of course, we're waiting to see what happens here with these job numbers to keep it all into play. Okay, well, let's talk a little bit about that. I mean, what's the ideal situation? If we get 25 basis point cut or if we get 50, what's the difference in that gold price move, do you think? Is it going to be significant or is it kind of priced in and baked in at this point?
It's an interesting question. I think that for the most part, a 0.25% rate cut is currently baked into current pricing, which means that, and I think that the probability are really, really low that they wouldn't cut rates in September, but if they didn't, that would put gold into a tailspin. I don't think that's going to happen. In fact, I'm certain, at least in my mind, it will not. And the question is whether or not they cut rates by 0.5%, because that, for the most part, hasn't been worked into current pricing. And that would provide gold a price boost, tremendous support, and take it, I think, as high as maybe, well, the recent high last week was about 25.60, and we just pulled the chart up, and you can see that right here, these tops that came in. That's the highest record close in history. So when we look at it that way, to get back there and above would be 25, 60, 70, 80. we could see numbers going into that area if the Fed cuts rates by 0.5%.
Right. Yeah, it's a fascinating time. I was thinking about you this morning, Gary. I opened up my emails and I had this new report in from Goldman Sachs. Analysts forecasting gold prices at $2,700 by early 25 in a new report that they just shared. 2 weeks ago, you were on this show. You said to expect $2,600 and then that $2,700 by year end, maybe first quarter. Looks like pieces are falling into place for you.
Well, I mean, it's what the charts say, and I believe that more and more analysts believe that that is possible. I'm still not in the camp that believes it's going to 3,000. I would love to see that, but the data does not support it. And so, yeah, I've been looking for 2,700 by first quarter next year for about the last month to 2 months. Once I revised my forecast upwardly back a couple of months ago. And yeah, we did talk about that a few weeks ago. And I still think that's a very viable target. Of course, anything can happen. That's a lot of time in between the first quarter next year and this last quarter upcoming. So we'll have to see. But I think those are realistic numbers.
Mm-hmm. You know, Gary, we've seen the U.S. dollar index reach some recent lows that match levels that we haven't seen since July 2023. Unpack this a little bit for us. You got a chart to break down for us. What are you seeing here?
Certainly. First of all, this is the dollar index. It is a longer term chart in that every candle represents 1 week in trading. We need that to pack this much data in. And as you can see, late last week, we had the dollar index go just around 100.50. And this 100 is key because we haven't seen that price point since July. But if we look at it on a technical basis, we have to go back to really April of 2020, really 2020 is the last time we really saw this become a top here. And the interesting thing about technical analysis, support and resistance is they're part and parcel of the same thing. So here it was a point of resistance. And when it blew that out, and this is really April of 2022, it took it all the way up to really 114 on intraday highs. When it came back down in July of 23, it actually touched almost near 100. And then we've been range bound between 106 and 100. And so we retested that. And last week it kind of popped off of that. And what will be interesting is whether or not the dollar can build some steam and move back up, or if it tests this area. Because if we get a hard break, say below 100, on a technical basis, there is no support that really comes in at all till around 98. But that was years ago, 4 years ago. So the dollar's in a very precarious position. And of course, a lower dollar benefits gold, obviously. Yeah. There's a 100% correlation. So if we get continued dollar weakness, that's another level, another layer that can move gold back near the record highs that we saw last week.
If we see dollar, I mean, we always know it's coming up to election time. We get the, no stimulus coming into the market yet, but of course we have some momentum. I mean, could this be start of a more sustained rally on the dollar? Or are you kind of thinking that this is still going to push weakness? Just a short-lived bounce?
Well, the way I look at it is once the Fed becomes aggressive about cutting rates, the more you cut rates, the more pressure it puts on the U.S. dollar. If treasuries are yielding lower yields, then it makes the dollar go down naturally because it's not as attractive to foreign investors. And so that could pressure the dollar lower.
Yeah. The defense trade still out there, people looking towards gold, even as central banks continue to buy. Okay, Gary Wagner, editor of thegoldforecast.com, unpacking the charts for us. Thanks for this, Gary. Of course, we'll see you back here in a couple of weeks. Going to be an interesting couple of weeks indeed, my friend.
Absolutely. Getting ready for a very, very critical FOMC meeting. It should be interesting.
Yeah, well said. Okay, appreciate your time, Gary. Thank you. Of course, we'll continue to monitor the markets and bring you the latest for all of us here at Kitco News. I'm Jeremy Szafron. Thank you for watching. Stay tuned. We'll see you next time.